So now taking a live look at Wall Street, the Dow Jones opening down more than 600 points today, just one day after the Federal Reserve raised its key interest rate by 3/4 of a point. This is the biggest hike in 28 years.
And the Fed chair signaled more rate hikes were coming to fight inflation. But what does that mean for all of you at home? Well, financial advisor John Lockwood joins us live this morning to explain. Thank you for joining us.
Hey, Mike, good morning to you. Thank you.
So, of course, this all means the cost for carrying a credit card balance, car loan, mortgage, it's all going to be more expensive. But by how much and what can we expect? How soon can we expect this?
You know, Mike, it's so interesting. The market changes so rapidly. The Fed decision came out yesterday, raising the benchmark rate 0.75%. And we saw the 30-year mortgage increase by nearly 0.5% just overnight. So this morning I'm reading that the average interest rate on the 30-year mortgage is now 5.78%. Okay, so that is up nearly 2.5% from earlier this year. So as interest rates increase from the Fed, what they're really doing is they're increasing what they call the benchmark. The benchmark is the federal funds rate. So that's the rate that banks loan money to each other overnight. And that really then creates kind of the base, and rates continue to rise from there. So think about, auto loans, mortgages, credit card rates, they're all adjusting as we speak higher, meaning that the cost of our debt is becoming more expensive, and that certainly will slow down our overall economic production.
John, there is so much to unfold here, so we want to try to get to a lot of it. Are you telling your customers and people that you advise, are you saying now is the time to pay off that credit card debt and lock in rates for the cars and the home loans because of things changing so quickly?
Yes, if you have variable interest rates, we are telling our clients to refinance, lock those into a fixed rate because those rates will continue to rise. The Fed has forecasted another 1.5% of rate increases throughout the rest of this year. So we can expect all of those variable rate loans will continue to adjust higher, making the debt service more expensive.
Let's talk retirement. A lot of folks are going to be looking at this saying, hey, I thought I may have this in the latter half of my years. What should folks who are nearing retirement or are in retirement do right now?
Yeah, right now is a really critical time to huddle with your advisors or experts to make sure that the investments in your portfolio are aligned to your goals. So if you're looking to retire in the near term and need to essentially convert the assets into income, then the investments need to be positioned to do so in a more conservative manner. In other words, to reduce the risk of the stock market potentially going lower as rates continue to rise. For folks who have a little bit longer of a time horizon, it's just important to remember what is the goal and to make sure that the investments are in alignment with your goal.
John, I want you to kind of break this down for folks too. The question is, are we headed toward a recession in your opinion? And then what about a depression? Do you think we would even get to that point based on what you're seeing now?
Based on what I'm seeing right now, Brandy, is that a recession is imminent. Right? Meaning that when we look at a recession, that is the global economy shrinking, meaning that production is slowing down. And really, that is the essence of what the Fed is doing. They're raising interest rates to slow down the economy. And so the consequence of that is going to be, we're going to see the economy go into recession. Now, the question is, how long is that going to last? Right? The Fed is not going to be incentivized to crash the financial markets, to put us into a deep recession or even a depression. So the Fed is really in a box. They have to raise rates high enough to slow down the money supply and slow down the demand, because that's really what's happening is, folks are spending freely, which is good for the economy, but it continues to put pressure on prices because the supply isn't there. So long story short, I think what we're seeing right now is a short recession followed by economic growth in the midterm.
All right, a lot of good information, John. Thank you so much for really explaining that to our viewers and kind of helping us all make sense of what's happening out there right now with our money. Thanks so much.